It's been a year of twists and turns, and we're only 6 months into it. 2019, let's be honest, hasn't been the most predictable of years for the financial sector. From high-level political risks to a darkening economic outlook to really critical regulatory advances on the fastest emerging risks, we've had plenty to keep us on our toes. And now that we're in the hazy days of summer, we can take a moment to look back and ask ourselves, what really happened? I'm Scott Martin from Deloitte's Centre for Regulatory Strategy, and you're listening to Regulated Radio. I've got David Strachan joining me again to give us his view on what's mattered most for financial firms this year. We'll be tackling all the big issues in this show, from Brexit to green finance, consumer protection, cyber risk, and even the state of global regulatory cooperation. Somehow, we'll cover all of this in the next 20 minutes or less. New Year's Eve might feel like yesterday, but we are, believe it or not, already halfway through 2019. This is our chance to check if we're still on track. This is Regulated Radio. It's a well-worn Regulated Radio saying by now that making predictions is hard, and particularly when those predictions are about the future. Well, it's just what we do here at Deloitte. Many of you will know that we publish an annual flagship report, our Regulatory Outlook, looking at what markets should expect for the year ahead in financial regulation and supervision. Now, halfway through the year, we hold ourselves to account and publish a mid-year review, seeing how we did and updating our forecast where we think it's useful. So for this, I am delighted to have David Strachan joining me on the show to give us his thoughts at what we've seen so far this year. David, as many listeners to the podcast will know, is the head of Deloitte's EMEA Centre for Regulatory Strategy. David, it's good to have you back.
Scott, it's very good to be here again, and I'm looking forward to our discussion. But I have to say, if you've seen hazy days this summer, you've got better eyesight than I have.
It's wishful thinking, David. It's wishful thinking. So, needless to say, given everything that's happened so far this year, there's a lot of ground for us to cover. But I wanted to ask you first, what are, in your view, the most important macro trends that you've seen which you think have a bearing on the performance of the financial sector and the approach that authorities have to take in regulating it?
Looking back, the biggest shift we've seen since we wrote the Outlook has been the downgrade in expectations for global growth, which has put interest rate normalisation on hold. Now, to put that in context, last November, markets expected that the US Federal Reserve would raise interest rates by at least 50 basis points in 2019. Now, they're expecting the Fed to cut rates by 50 basis points this year. And it's much the same story in the euro area. This means that the pressure on banks and insurance companies' business models from low interest rates will persist for some time to come. There's still no respite in sight. That said, the late cycle economic risks that we saw in December are still present and are still concerning. Global debt levels are still higher than pre-crisis. Non-bank lending continues to grow, as do levels of consumer credit. So, unsurprisingly, given that backdrop, we expect regulators will continue to test firms' resilience to any economic downturn or market shock.
So I'm wondering, David, as you've said, there are many lingering risks in the financial sector, but what risk do you think has risen up the radar of regulators most quickly this year?
So I'm going to give you three for the price of one. The first is risks from the leveraged loans market. The Financial Stability Board announced in March, I think it was, that they were launching an inquiry into better understanding the exposures that the financial sector has to leveraged loans. I mean, particularly those wrapped up in collateralized loan obligations. They're due to report back on this in the autumn and take a view from there on what international regulatory efforts might be appropriate. Closer to home, in the UK, more than a third of corporate debt is in companies whose total debt is more than 4 times their cash flow. The second one concerns crypto assets, or cryptocurrencies, as some prefer to call them. Their rapid developments are causing regulators to review their existing frameworks to identify and close gaps where at present the regulatory framework doesn't really cater for crypto assets. The key question for me is whether regulators can do this quickly enough given the speed with which the market is moving ahead. And third, very recently in the UK, the suspension of redemptions for a high-profile investment fund with material holdings of illiquid assets has triggered intense public, political and regulatory concern. In my view, this is going to lead to renewed regulatory scrutiny of fund liquidity management, liquidity stress testing, and ultimately the question of whether open-ended funds should be allowed to invest in these illiquid assets.
3 very interesting points right there, but I'll bring in the elephant in the room. I think none of our listeners will be surprised to hear that we see Brexit as one of the biggest uncertainties weighing on the decisions of financial services firms this year. And so far, we've seen no resolution to this stalemate on how the UK will proceed with leaving the European Union. What, David, in your view, are the top Brexit risks that firms should be considering now as the journey to a post-Brexit world continues?
Since we wrote the 2019 outlook at the tail end of last year, we now have a new date for the UK's departure from the EU, the 31st of October this year. But other than that, relatively little has changed. The likelihood of the UK Parliament passing the Withdrawal Act looks low, and indeed, if anything, lower than it seemed last December. 31st of October looks to me like a very real cliff edge, although financial services firms are better prepared than they were, having completed the setup of their new subsidiaries somewhere in the EU 27. However, they need to use this breathing space effectively, and that means preparing for EU 27 supervisory scrutiny of the issues that we know the supervisors care deeply about, things like governance, booking models, outsourcing, and in the asset management area, delegation arrangements, and continuing the process of migrating clients to the new EU 27 subsidiaries, a process we know is proving hard-going in some, perhaps almost all cases. And then the nature of the UK's future relationship with the EU also remains unclear. However, in a burst of activity just before the end of this term of the European Parliament, a number of legislative measures were passed, which, depending on how the new powers are used, could make it much more difficult than it is today for third country firms to access EU markets from outside the EU.
I'm wondering, do you think this has any connection to the capital markets union work the EU has been pursuing?
Yeah, I definitely think it does. I think that what the new European Commission and Parliament do in relation to the Capital Markets Union initiative will be really interesting to watch, really interesting. The early move by France, Germany and the Netherlands to establish a high-level working group on the CMU looks to me like an attempt to set the pace and the agenda for future EU work in this area. We will see what it comes up with when it publishes its report at the end of September, and the extent to which its conclusions are endorsed by other member states and, of course, the new Commission. Personally, I'm sceptical about initiatives to create markets through regulation, but I've absolutely no doubt that the EU will give it its very best shot.
Indeed, and apart from the Capital Markets Union, it also seems that the EU might be gearing up for a big regulatory push on the sector's preparedness for climate change and climate risks. What are you seeing from financial regulators already, and how do you think their approach to the greening of finance is going to develop in the near term?
So climate risk is clearly rising up the agenda, and indeed rising up very rapidly across the board. Politicians, regulators, supervisors, and many more besides. And in the European Union, with the Greens potentially entering a grand coalition in the new European Parliament, seems to me likely, and indeed inevitable, that climate-related risks will be even more prominent in financial services regulatory initiatives, particularly at the EU level. Clearly, the EU institutions are already very active in relation to climate change. We saw that in the course of the last calendar year. The European supervisory authorities, for example, they've published recommendations for integrating sustainability risks into MiFID II, into UCITS, into the AIFMD, the Insurance Distribution Directive, and Solvency II. So it is already, as an issue, quite pervasive and looks to me set to become even more so in the next Parliament. Closer to home on the supervisory front, the UK's Prudential Regulation Authority is setting the pace. Banks and insurance companies now have until October to develop a plan that meets supervisory expectations on managing the financial risks arising from climate change. But even if other countries' supervisors are slower out of the blocks than the PRA, it's possible, and some would say likely, that investors and other outside pressure will force financial services firms to move very fast in terms of addressing climate-related risks. There's certainly no grounds anywhere for complacency here.
Now, David, at the start of the year, we said that the regulatory focus on cyber risk and the broader IT resilience of the financial sector would continue to grow as a top issue, and the way that authorities deal with these risks would become much clearer. Have we seen that materialize yet?
In parts, yes, Scott. But I think we have to acknowledge that it's taking a bit longer than we expected to see the proposed frameworks for dealing with operational resilience in particular. We're still waiting for the UK authorities to produce their consultation paper on operational resilience, which I think is now scheduled for this autumn. And the European Central Bank still has to extend its approach to cyber risk to the main banks that it supervises. So I think the direction is still very much there, but the timing is a little bit slower than we thought. Perhaps inevitably so, given the complexity of some of the issues here. Having said that, the really important strides that are being made in cyber risk testing, the G7 exercise in June, the first of its kind and a major step forward. And, of course, in the UK, the cyber risk stress tests are proceeding. And, I mean, recently, I think really interesting to see that the European supervisory authorities have recommended that the European Union bring cloud service providers into the financial services regulatory perimeter. That, I think, is a longer-term trend to watch and clearly will depend on what the new Commission and the new European Parliament do with that recommendation.
So, David, if we shift from financial stability concerns to the fair treatment of customers, and particularly retail financial services consumers, it's been, I think, interesting to see what regulators are doing in putting increased pressure on investment managers to show that they're offering value for their customers' money. Do you think financial regulators in the UK and Europe are slowly becoming price regulators?
Yes, up to a point. I think we're certainly seeing the trend across the UK and the broader EU. But the UK is, in my view, the most advanced at this stage. And specifically here, authorised fund managers in the UK are being given a new prescribed responsibility for value assessment under the senior managers regime, and that will kick in this autumn. As far as we can tell, this is unprecedented across Europe, Middle East and Africa in terms of pinning a specific responsibility for value assessments on an individual. More generally, there are plenty of signals from the FCA that it is willing to intervene to correct products it perceives as offering poor value to customers. Its latest move in this area was to prohibit banks from charging higher fees for unauthorised overdrafts than they do for authorised overdrafts. But that's only one of a number of examples.
Do you think this is something we'll see the EU move on soon?
There's certainly scope for the EU to move here. I recall that the European Securities and Markets Authority found that retail investors pay twice as much in management fees to use its funds than do institutional investors. And on the insurance front, the European Insurance and Occupational Pension Authority's recent publication on conduct risks in insurance places a lot of emphasis on value for money. But of course, much depends on whether national supervisors take up this particular baton. Our sense is that some EU supervisors would certainly like to be more active in relation to value for money, to do more, but feel that currently they lack the necessary powers to intervene in the way that the FCA has done.
So, zooming back out to the very big picture, the second half of 2019 will mark 10 years since the G20's famous Pittsburgh summit in 2009, when they launched the regulatory framework to respond to the financial crisis. Gosh, that makes me feel old. But that's also the G20 meeting that launched the Financial Stability Board as the global regulatory body that we know it to be today. David, you were part of the UK regulator back then, and you've been closely involved in that work ever since. How effective do you think this experiment in international cooperation in creating a global level playing field has been over that time?
Scott, I think the short answer to your question is that the regulatory community has made huge progress over the last 10 years under the guidance of and leadership of the Financial Stability Board and the broader G20. When you look back at 10 years ago when this started, it would have been very difficult to envisage the massive amount of progress in revamping the regulatory framework that has been achieved in what is a relatively short space of time still. And in that context, for me, the real positives have been numerous. The significant progress on back capitalisation, much higher liquidity levels, moving derivatives into central clearing and out of the over-the-counter market, greater transparency, and last but by no means least, real progress on resolvability. And I don't think that anything can or should detract from that progress. Having said that, I think it's only fair to acknowledge that over the last couple of years in particular, what we're seeing is some fragmentation where previously there was integration, and some divergence where previously there was convergence. The consistency of regulatory approaches has frayed a bit at the edges the further we move on from the crisis. And I think sitting now in June 2019, there are some big questions about the implementation of the final phase of Basel III. We'll be able to see a bit more, guess a bit more about the EU's likely approach when the European Banking Authority publishes its impact studies later this year. The UK's approach will also be really interesting, since this, of course, may be the first major piece of financial services legislation that goes through the UK parliamentary process once the UK leaves the EU. And how much of that is implemented in primary legislation and how much is left to PRA rules will set, in my view, a very important precedent for future UK rulemaking in the financial sector. And just rounding off what I appreciate is a long answer, but I think it's important to say that it's a real positive that the G20 and the Financial Stability Board have made it their priority this year to address regulatory divergence and market fragmentation. But fragmentation, I fear, once it's started, is a very difficult trend to reverse.
All right, David. Now, it's time for what is fast becoming my favorite part of regulated radio, the part where we put our guests on the spot and ask them to make a prediction about the future. This might, I think, be even harder for you, given that our focus for the show has been on the developments of a year that's already half over. But as I'm certain you're up to the challenge, I'd like to know what you believe will be the most important regulatory event that we would see materialize over the next 6 months.
Well, Scott, I'm going to push out the boundary of a regulatory event. For me, the most important regulatory event will be the appointment of the next governor of the Bank of England and the taking of office of the next president of the European Central Bank. Now, I'm not going to offer you a prediction on who those individuals are going to be, but I think the consequences of those appointments are going to be very far-reaching. And many commentators will quite rightly focus on what this means for monetary policy, and in particular whether we see these individuals support even further monetary easing if economic conditions deteriorate. That in turn has very important business model implications for banks and insurers, as I mentioned at the outset, which face strained profitability in a persistently low rate environment. So that's certainly one to watch. But I think more broadly, we also need to bear in mind that these individuals will head organisations which are the most significant prudential regulators in Europe. Between them, they supervise 11 out of the world's 29 global systemically important banks. So as well as being hugely important appointments in their own right, the tone from the top that these two individuals set for cooperation between the two institutions in a post-Brexit world will, in my view, be key to how supervisory cooperation works in practice. And as we know, supervisory cooperation is vitally important. And that in turn will be critical for those financial services groups which now have had to establish one, or in some cases more, new subsidiaries in the EU 27, and how much additional supervisory friction and hence cost they'll have to absorb. So all in all, across many dimensions, really hugely important appointments.
All right, David, thanks so much for coming back on the show.
Thanks, Scott. Very good to be back.
And there it is. Lots of interesting developments so far, and we're only at the halfway mark. If you think about how some of the big regulatory trends we've been talking about today, important developments on cyber risk, on green finance, on consumer protection, and even the leadership of the financial system itself, you'll forgive me for suggesting that the second half of 2019 might be even more eventful than the first. So, if you're interested in hearing more about our regulatory outlook for 2019 and the updated predictions we've just published, you can find it all at deloitte.co.uk/regoutlook. And don't forget, if you listen to regulated radio and think, this is brilliant, then do us a big favor and recommend the show to a friend or a colleague. You know they'll want to join the podcast revolution. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.